Are you so excited this is back in the podcast?
So excited.
Monday Money Tip Podcast.
Well, welcome to the Money Tip Podcast presented by Fully Funded Life. My name is Joe Sangle. I'm fired up to help you win with your money so that you can live a fully funded life. I'm joined by my co-host, Megan Hibbard, who's joining me from North Carolina today. Are you fired up?
Fired up. Happy Monday or Tuesday or whatever day it is.
Yeah. Yes. Yeah. It's Monday. It's the Monday Money Tip. So everybody rushes to listen to the podcast on Monday. But if it's another day of the week, we're happy you joined us.
There you go.
Tell everybody what episode number we're on.
Yes, so we are on episode number 347. And today, so the markets are up, then they're down, then they're back up. And your emotions are doing the same. So today we're sharing expert-backed tips to help you stay steady and smart even when the market gets shaky.
We're going to give you some tips for thriving in a volatile stock market. And volatility, of course, is not the enemy, because volatility is always going to be there. So if that's the enemy, well, then we're always going to have an enemy. But reactionary decisions are emotional decision making. And so today we're going to talk about what type of mindset you should have for investing in that type of stock market, some strategies and some actionable tips. And before we get started, Megan, you know what time it is. Dun, dun, dun. Dun, dun, dun. It is current money events time. Current money events. Current money events time. Current money events. Are you so excited this is back in the podcast?
So excited. Cannot.
So
contain
Megan
my
is going to share the current money event today. She's like, I am? Yes.
Because
well,
in our notes it says Joe.
Well, you know, what I want to share here is a current money event. As we talk, the national debt has gotten to $36.944 trillion. That is $107,852 per citizen of the United States. However, not every citizen pays taxes. Is your Logan, is he paying taxes yet?
No.
I know he's cute. Does he have a modeling contract or anything?
He should. He is so handsome.
Okay. You know, parents are paying taxes. So per taxpayer, Megan, that debt is the equivalent of $323,051 per taxpayer. Are you fired up?
Fired up.
And so I encourage everybody to go to usdebtclock.org. It will also show you a Doge clock where they're tracking how much money has been saved through the Department of Government Efficiency. You can click on how they calculate that number, but right now it says it has saved $4,523 per taxpayer, or about 1.3% of the amount you owe if the debt was spread amongst every single taxpayer. Aren't you fired up, Megan, that the federal government has spent $323,000 on your behalf?
So kind of them.
Isn't that great? So at some point in time, that's got to be fixed, because can you imagine if that money was returned to the taxpayers, or if that money had been spent? I think that would buy a pretty decent house, or definitely put a lot of money towards a house for the average taxpayer. So I just encourage everybody in this current money event section to monitor the usdebtclock.org. It is a wonderful resource. By the way, there's a lot of other information on there by your state. You can see the amount of credit card debt, the amount of interest being paid. There's approximately 150 different little meters that are running on there that I think would be great. So that's it for the current money events section. Yep. She says yep. All right. So we're going to continue on with our podcast and helping you navigate what seems like volatile times in our financial journeys.
Yeah. So in the beginning, you mentioned volatility and that it cannot be avoided and that it is normal. So First, we're going to give you a quick definition. So volatility just means the market is moving, sometimes a little bit sharper than others. It doesn't always mean a disaster. It just means change.
Yeah, and in recent times, I mean, everybody's hearing it. I mean, people are
Yeah.
aware. The word tariff, woo, that makes the market move. It makes it volatile. The word big, bold, beautiful bill makes the market move. The president is speaking, moves the market. There's a couple other people that people don't know as much, but the leader of JP Morgan, Jamie Dimon, when he speaks, tends to move the market. When Jay Powell, the chairman of the Federal Reserve, speaks, it moves the market. So volatility, well, that is what happens. It is people rushing to sell or more people rushing to buy, and that drives price. It is very basically boils down to supply and demand. And supply and demand, when those are off balance, causes volatility. So it is normal, and it's part of a healthy market cycle. Maybe you could give an analogy, Megan. I'm up here talking in the clouds. Can you bring it down to the level so everybody can understand what we're talking about?
Yes. Okay, so think of the stock market like the weather. Okay, you'll have sunshine, like I currently have. It's a beautiful day today. But yesterday, it monsooned, like monsooned. And then we have everything in between. One day rainy doesn't always mean the climate is broken. It just means that it's raining that day.
And occasionally, of course, you get really catastrophic events like a tornado, like a hurricane, right?
Yeah.
So that stuff happens in the market as well. Every now and then something is abnormally large and has an adverse reaction. And of course, that gets the news cycle, the spin cycle, the never-ending talking 24-hour television and live everything on social media. And so it happens because of news that's being reported, interest rate changes, elections, of course, global events, and people are emotional about their money. I don't know if you knew that, Megan. That is breaking news on the podcast.
Breaking news.
People are emotional about their money. And of course, there are algorithms. People are trading based on numbers alone and certain formulas, and that can amplify swings. So the big takeaway here is don't confuse all this volatility with risk. The market moving isn't always the market breaking, and that's really important. A lot of times when the thing goes crazy down or crazy up, people panic and they make some wrong moves. And panic selling at the bottom is one of them. What are a couple other wrong moves that people make when there's market volatility?
Yeah, so trying to time the market. So knowing, oh, it's going to go up, so I should do this. It's going to go down, I should do this. This is going to happen. We don't know the future.
Megan, this is kind of funny. I have read a study where a person put a so-called expert on timing the market up against like some guppies, like fish in a fish tank, on like when they blew bubbles. And blowing bubbles meant buy or sell. And they put that up against this expert, and the guppies won like 50% of the time.
Oh, wow.
And so it's really saying, if you think you can time the market, listen, that's called day trading. And day traders, one thing that we know, almost all of them collapse and fail. It may take them a year or two, because if the market is on a massive upswing, they can feel like they're invincible. But they almost always wash out within a couple years. So trying to time the market is a wrong move. Another one is, of course, following the hype, which is, news, social media, and even worse, tips from a friend. Oh my goodness. That could strain your friendship. And another wrong move that a lot of people make, Megan, is what?
Overchecking portfolios or reacting emotionally, which is...
If you check your portfolio all the time, you cannot help but become attached to it, because let's bring in the word here. Jesus said in Matthew 6:21, wherever your treasure is, there your heart will be also. He is stating it as a matter of fact. It is a matter of fact. And the more you look at those dollars and they start going down, It's like, oh, I need to sell. And it's going up. I'm missing out. I need to buy a bunch more. And so you're practicing the old principle of buy high and sell low, which will lead to brokenness. So don't make those wrong moves. And let's give you some tips for staying smart when there's exceptional volatility. And the first tip I would give you is to zoom out. Think longer term. You know, market dips are temporary, but over the long term, trends rise. And this is what we like to say is the 5-year rule. It's Joe Sengel's 5-year rule. And if you take any 5-year period of the stock market, based on the S&P 500, on any start date, I'm not talking about calendar years, any start date finishing 5 years later, that 97% of those 5-year periods have made money. And 100% of those 10-year periods have made money. But if you choose 1-year periods, well, a lot of those have lost money. And so you've got to zoom out. You've got to have a bigger picture. So for me, I've implemented the 5-year rule. And I encourage our podcast listeners to have a similar rule. And that is, if I think I need this money in the next 5 years, I'm not going to invest it. I'm just not. I'm going to put it in safekeeping because volatility, I think I need that money. I'm going to panic in the short term. So if I don't have money invested that I don't need in the next 5 years, I'm less likely to panic. Okay? Now, give them tip number 2.
Yep. So revisit, not react to your plan. So ask how your goals have changed. If not, don't overhaul your strategy. So we're looking at rebalance instead of reacting.
I like this. You know, it's good to revisit your plan, but to make massive reactions to it, that's a problem. I publish my investment update every year for the Fully Funded Life membership community. And I give my prognostications of what I think is coming in the next year, but I also revisit last year's. But in reality, the genesis of that, the birth of that update, Megan, was because I was revisiting my plan. And I realized that investment questions outnumber any other questions 10-1. And I just wanted to help people understand how I do this. And not as an expert, but hey, this is a way. And a way is better than no way. And many people, Megan, we've all been guilty of getting the investment update in the mail, getting in ping in the email box, and we just file it away in the archive, or if we get the printed one still, it just goes in the pile, and it goes in the pile with the 30 other unopened ones. Well,
Right.
you know, it's important to revisit it and look at those. So do that.
Yeah.
And
All right.
a third one is the what?
Yeah. So diversify intentionally. So we don't put all of our eggs in one basket or one stock, one sector, or even one or a country. So
Yeah.
bonds, international funds, and alternatives can help smooth the ride.
Ecclesiastes 11:2 says, invest in 7 ventures, yes, and 8. You do not know what disaster may come upon the land. What is Solomon saying? He's saying, yo, that's exactly what he's saying. Yo, be diversified. And so make sure you're diversified. And trust me, if you're invested in mutual funds, you probably have excellent diversification. Very important. And then keep investing. Our 4th tip is to keep investing, even when it feels scary. Warren Buffett is famous for saying he's made the most money by going into the stock market when everybody else is running out. And dollar cost averaging is what happens when you invest all of the time, consistently over time. And dollar cost averaging strategies have proven to win out almost every time. Not every time, but almost every time. And it's definitely been the most proven way for everybody to win financially over time. Now, a few people have invested in only one stock, and they've only done one stock, and they've made out a lot more, like buying only Apple stock for the last 30 years. But the vast majority of people, they would have bailed out along the time when Steve Jobs got fired and things like that. And as a result, that volatility would have flushed them out. So the best way is diversified investments all the time. Keep investing. And then, of course, number 5, Control
Yep.
what you can.
Mhm.
So Megan, tell people, let's talk about what we can control.
Yeah, so you can control your saving rate, you can control spending and emotions, even though sometimes it's challenging to do that. And
Yeah.
you can honestly unsubscribe from fear-based content. That's something that I've been practicing.
Unsubscribe or turn it off. Just
Yeah.
turn it off. I've actually thought about this, Megan. Like over the last 3 months, we've heard Freedom or Liberation Day or whatever is when tariffs were enacted on April 2nd.
Mhm.
And the market ran down. I mean, it went down a lot, like 10, 15%. And now it's almost gathered all of it back here 3 months later. And I've wondered, if a person was, who was it that took the long nap? Was it Rumpelstiltskin? Who took the nap under the tree? I can't remember who took the long nap. What's the fable where the guy took a long nap?
I don't know. We can go with Rumpelstiltskin. I'm trying to remember what his thing is.
Rip Van Winkle. I know somebody's
Mm.
listening and saying, Joe, it's not Rumpelstiltskin, it's Rip Van Winkle. Remember Rip
Yeah.
Van Winkle? He meets a mysterious, he imbibes her strong liquor and falls deeply asleep. That's the fable. And he awoke 20 years later, and he missed the American Revolution. Anyhow, what I'm saying is, you're Rip Van Winkle and slept through 2025, the first half of 2025, you would wake up and your investments are about the same.
Mm.
And you would have avoided a lot of fear, a lot of hysterics. And Warren Buffett, the great investor, one thing he says is, when I buy a stock, I'm okay if the stock market's closed for the next 10 years because I'm not making a day purchase. I'm making a purchase for decades. And so control what you can. And so you can control continually investing out of your paycheck to your 401k or similar retirement plan. You can choose to invest in diversified investments. You can choose to regularly, but not daily, revisiting your plan. And you can choose to zoom out and think long term. And so people are asking questions right now, Megan. And so maybe you can ask me the questions, and
Yep.
you can be the person asking the question. Our podcast listeners are asking them. I'll answer them. Ask them.
All right, the first one. Should I pull my money out?
Probably not. Probably not, especially if you don't need the money the next 5 years. Seek the advice of a competent professional, but stay the course. Should I stop contributing to my 401k? No. Keep contributing. It's dollar cost averaging. What if I'm close to retirement? What should I do? Well, number one, think about that 5-year rule and go talk to a financial and retirement planning expert. They may advise you to shift to more conservative assets to help your emotional journey and help you be fired up and take away this idea of being panicked along the way. So listen, volatility is not a signal for you to panic. It's a reminder for you to stay focused. And my challenge to you this week is to revisit your investing plan, not your portfolio balance. And make sure you keep it always connected with your long-term goals and what you've defined as your family's fully funded life. And listen, if this helped bring you some calm, just breathe in and out. And if it helped you stay the course, hey, share this episode with a friend, maybe a spouse, and leave a quick review. I think you'll find it to be very helpful. Any last thoughts, Megan, as we wrap it up?
Yeah, I mean, I think it's easy to get caught up in what's happening around us, and easy to get into the fear-based content, and easy to let everything overwhelm you. So I think in those moments, revisiting this podcast if you need to, re-listening to it, thinking through, should I pull out? Well, the money, should I pull my money out, or should I keep investing? Well, like we mentioned before, are you going back to those plans, hopes, and dreams? Why are you investing? Are you investing so that one day you could do X, Y, and Z? Are those things still there? If they are, then you should leave it, So I think it's things like that, of going back to our why and going back to our plans, hopes, and dreams and thinking through those things. And that can help guide us on this journey, because it's not just an investing journey. It's bigger than that. It's your why. And this is an avenue to help get you there.
Just remember this: panic rarely, if ever, helps you in an investing journey. Panic rarely helps. Panic means you will take action based on emotion. Emotion will almost always lead you astray. And if you pulled all your money out of the account, that means you're trying to time the market. And you have to make two good decisions. You have to pull it out at the right time, and you have to put it back in at the right time. And that means if you can't time the purchasing side good, how in the world are you going to time the sell and the purchase of it good? The odds are stacked against you. Listen, volatility, it's part of investing. Breathe, invest for the long haul, be diversified, and call us in a decade. I think you'll be very glad that you took our advice. Hey, we encourage you to check out Fully Funded Life, our membership community where you get access to education, challenges, and included coaching with live coaches who are there to help you answer your financial questions and to hold you accountable so that you can live your fully funded life. Check it out, fullyfunded.life, and we'll see you next week. Get fired up. Hey friends, thanks so much for watching this video. Hey, can I ask you to do a couple things for us? One, thumbs up if you like the video, subscribe so you never miss out on content, and check out the next video. I think you'll find it helpful too.